Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about DIVERSIFIED HEALTHCARE TRUST Quarterly Report. DHCS Business Overview. DHC is a real estate investment trust that specializes in owning high-quality healthcare properties across the United States. The company's portfolio includes various businesses and services such as senior living units, medical office spaces, life science properties, healthcare facilities, 341 properties, property management, asset management. These services are provided through a diverse range of care delivery and practice types, scientific research disciplines, property types, and locations. DHC is managed by the RMR Group, a leading alternative asset management company with extensive experience in commercial real estate. The significant increase in Diversified Healthcare Trust, DHC, stock price over the past year can be attributed to a combination of strategic initiatives and market recovery. Key drivers include the recovery of the senior housing sector, with anticipated improvements in operating results by 2024. The company's effective debt management and liquidity enhancement strategies have also contributed to its success, including the sale of medical office buildings and underperforming communities. Additionally, positive analyst ratings and credit upgrades have boosted investor confidence. B. Riley raised its price target for DHC shares, while S&P Global Ratings and Moody's upgraded the company's corporate family rating, citing reduced refinancing risk. These factors have collectively contributed to a 58.43% increase in stock price over the past year, with a 52-week high of $4.58 as of September 17, 2025. The primary drivers of revenue growth or decline for the company can be attributed to several key factors. On the decline side, rental income decreased by 9.8%, and occupancy rates dropped from 94.2% to 92.5%, resulting in a decrease in same-property NOI by 12.4%. Additionally, impairment charges on medical office properties and senior living communities held for sale contributed to revenue decline. On the growth side, residence fees and services increased by 7.1%, and average rent per unit rose by 2.6%. The shop segment also saw an increase in rental income and residence fees and services revenue. These factors suggest that while there are challenges in certain areas, the company is experiencing growth in other segments, particularly in residence fees and services. Net income and profit margins. A decline in performance. The financial performance of a company has seen a significant decline in net income and profit margins over the past few months. Net income decreased by 66% from -$98,689 to -$164,040 for the 3 months ended September 30, 2025. This substantial drop can be attributed to a decrease in revenue across various segments. Profit margins also suffered, with total NOI decreasing by 1%, $624, from $63,943 to $63,319. However, some segments showed improvement, such as the shop segment, which saw an increase of 8%, $2,187 in NOI. Conversely, other segments like medical office and life science, and all other experienced declines of 4.1%, $1,152, and 19.1%, $1,659, respectively. The decrease in profit margins can be attributed to the decline in revenue across various segments. The company's performance has been impacted by a combination of factors, leading to a significant drop in net income and profit margins. The company's financial performance indicates a strong trend of generating positive operating cash flow. The 3 months and 9 months ended September 30, 2025, both show net operating income NOI in the positive range, with $63,319 and $205,989 respectively. This suggests that the company is successfully managing its operations to produce consistent profits, thereby ensuring a steady stream of cash flow. The company's financial situation has undergone significant changes. The total debt has decreased from $3,178,162 to $2,723,365, indicating a reduction in liabilities. However, there is an increase in mortgage notes payable due to refinancing, which may offset some of this decrease. More notably, interest expenses have seen a substantial decline. In 2025, the company's interest expense decreased by -$48,000 $886 compared to the previous year, and for the first 9 months of 2025, it dropped by $157,643. This reduction in interest expenses is a positive sign for the company's financial health. Despite some inconsistencies in the summaries, it appears that the company has made progress in managing its debt level and interest expenses. The company's financial performance varied across different segments and regions. Notably, the shop segment saw a revenue increase of $161,605, while the medical office and life science portfolio segment generated significant rental income and other revenue. However, these positive performances were overshadowed by poor results in certain areas. The senior living labor and benefits segment incurred an expense of $172,422, while both the shop and medical office and life science portfolio segments reported losses of $19,964 and $14,478 respectively. Management is optimistic about the company's outlook, expecting continued growth in occupancy and positive performance in the shop segment. They anticipate favorable supply and demand dynamics in the senior living industry, which will drive growth. To achieve this, management plans to invest capital in properties through redevelopment projects, increasing returns. They also expect to fund leasing-related obligations using operating cash flows and other sources. However, they acknowledge potential challenges from market conditions and creditworthiness, as well as a protracted negative impact on the economy or industries, which could affect their ability to satisfy financial covenants. Acquisitions and divestitures overview. The company's financial summary reveals minimal activity in terms of acquisitions. However, the divestitures section highlights significant transactions. In terms of divestitures, the company sold a total of 64 properties between December 31, 2024 and September 30, 2025. The aggregate sales price for these properties was $395,805, excluding closing costs. This includes 32 properties sold for an aggregate sales price of $353,675, 12 additional properties sold for an aggregate sales price of $42,130. The company also reduced its assets held for sale from $276,270 to $258,389 between December 31, 2024 and September 30, 2025. Alaris Life's financial transactions, dividends and share buybacks. Alaris Life has engaged in two significant financial transactions in recent years. Firstly, the company has paid dividends to its shareholders. On February 14, 2025, Alaris Life distributed a total of $50,000 as cash dividend, with our pro rata share amounting to $17,000. In addition to paying dividends, Alaris Life has also bought back shares from its existing shareholders. In a notable transaction on February 16, 2024, the company purchased approximately 34% of its outstanding common shares at $1.31 per share for a total cost of $15,459, including related costs. This move demonstrates the company's commitment to managing its capital structure and shareholder value. Supply chain concerns loom large. A review of the financial summary reveals that there are legitimate worries about inventory buildup and supply chain disruption. Specifically, pages 53 and 54 highlight these concerns, indicating a potential threat to the company's operations. This issue warrants close attention from management to mitigate any negative impacts on the business. That concludes the financial summary for DIVERSIFIED Healthcare Trust. Feel free to comment below, and I will be happy to answer them when possible.